Inventory is a central part to many companies dealing in the business of goods. Inventory tracking, therefore, is a prominent part of many operations. So, if you're a company that produces inventory, your inventory will go through three stages, which consist of raw materials, work in process, and finished goods. Starting with raw materials, these consist of all direct materials used in production. This could be lumber used in building tables or rubber used in tires. So not to get too technical into the accounting, we would put the addition of direct materials into this left-hand column, which is known as a debit. Next, we have our work in process, which includes raw materials as well as any direct labor used. We also add something called variable overhead, which consists of things such as energy expenses, janitor wages, repairs and maintenance, and depreciation. These are all added up to compute the expenses involved in getting these products built. All these expenses are then added to the left-hand side of the column, also known as a debit. Finally, we have our finished goods, which is where our inventory goes when it is boxed up and ready to be sold. This is the last destination for our inventory, and any additions go into the debit side. Inventory flows from the direct materials category to work in process to finished goods in a very simple way. When we buy raw materials, we record this on the left side, also known as debiting direct materials. When we are ready for these raw materials to move into work in process, we record this on the right side, also known as crediting direct materials. Now, in order to get these expenses moved to work in process, we simultaneously record a debit to work in process for the exact same amount. As time goes on and we are ready to move these products to finished goods, you guessed it, we credit work in process and debit finished goods. When we finally sell our finished goods, we credit finished goods and the inventory cycle comes to a close. Now let's look at this with an example. Imagine we are building a bike. We purchase $50 worth of metal, $10 of rubber, and $15 of miscellaneous parts. We would go ahead and just debit all of this to direct materials. When we are ready to begin working on the product, we go ahead and credit raw materials and debit the exact same amount of work in process. Let's then assume we spend $80 on direct labor, $20 on utilities, and $10 on repairs and maintenance. We would debit all these expenses as well, as they are increasing the cost of inventory. When the inventory is finally complete and ready to be sold, we would credit that amount and simultaneously debit finished goods. Let's go ahead and assume that $185 of inventory we sell $120 worth of it. We would then credit finished goods for $120, with the remaining $65 still waiting to be sold. I hope you guys enjoyed the video today. If so, please feel free to like this video, as well as checking out the link in my bio where you can find all my spreadsheets to help you with wherever you're at in life. Thanks!